man, welcome back to another crazy stock market. That's what we're in. We've kind of been in this for a while now, which is crazy because it feels like maybe we met during COVID or during the 2018 crisis, because 2018, at the end of the year, we had a crisis thanks to JPOW, stocks going down and plummeting, the bond crisis, then we had the COVID crisis. Now it's just like we thought the crisis was over. We could finally go back to normal. And no. I mean, of course, Ukraine's still going on, politics, government shutdown talk, can't have a Speaker of the House, can't have peace in the Middle East. Now, this disaster with Israel just feels like it's getting worse every day. Yet, for some reason, there are some people in the media that are saying things like, oh, oil falls as concerns about Middle East ease. It's like, what? No, oil's down 3%. It's at $88, but everything still feels like a crisis over there. Then, of course, you got headlines like McDonald's bragging about how much inflation and how much pricing power they have, when the reality is they don't really have pricing power. They have faux PP. But then again, other companies that have pricing power within their sectors get absolutely decimated when interest rates go up. So it's like, what's better? Faux PP that's not interest rate sensitive, or strong PP but that is interest rate sensitive? I don't know. But all I know is we've been through a lot the last like 5 years of just like drama. It's just this, it's just nonstop. And it's crazy. I mean, even to the extent that today is crazy. Zoom into today. This is why we need therapy. So look at today. So today, you start the market green, you pop right out of the gate, only to fall straight down to a low of the day, recover back to a low of the day, and now we're rallying into the close. What is this? What world are we in? I don't know. But when we look at bond yields, I mean, I don't want to say it because every time I feel like it gets said, we end up breaking to a higher level. But some would say it feels like maybe bonds have finally hit their bottom. Oh, not great. You've got this idea that bonds can't go any bond yields can't go any higher. You've got Bill Ackman, who's covered his short, saying, bonds are too good not to buy right now. And so what do we see? Well, go to CNBC. It's very simple. We got our 10-year right here. Look at where we sit on that 10-year. I mean, you could just go into the last month. 3 months, a little bit more of a picture here. You wonder why the stock market's been going down the last 3 months? There you go. That's all you have to look at, is why would the stock market go down for 3 months in a row since about July 19th? It's a bear steepening of the yield curve. It's the skyrocketing of the 10-year. Simple. So, question is, when does that pain end? Well, it depends how many earnings seasons we got to get through to have low comps to compare to and low expectations to compare to. And I think sometimes what that takes is people starting to have really negative, like overly negative expectations of the future. When individuals and investors get too negative about the future, then you could start beating and surprising. And then, of course, you get the suspicion that, oh, there'll be a double dip. And hopefully you can break out of that and not end up having a double dip. All of that is hope, I suppose. Others say that, hey, you know what? Maybe the bearishness that we're seeing is just a sign of the times, that maybe the bearishness isn't actually truly bearishness. Yeah, this is literally the Financial Times has a piece today talking about how people are more pessimistic today than they were during the crashes during the 1970s, which that was Paul Volcker era. That was when we had audio's. Oh, not that again. Oh, I hate it. No way. Why does it do that?
Well, hopefully you were able to hear that. Thank you for that. I just got that. I got to go through the checklist, man. I go through the checklist, but I always assume that's okay. And that's the problem. Audio test. It's on the checklist. Got to go through the checklist, Kevin. Anyway, so hopefully, I know that's going to be a lot better. But hopefully you were able to hear that audio in the meantime. Anyway, so, okay, now that I've kind of lost a little bit of my train of thought, I guess it's time for a reminder that you should check out investing in HouseHack. Yeah, deadline tomorrow. or not tomorrow, in 2 days from now. Yeah, November 1st. Okay, let's get back on track. All right. Okay, here we go. Take a look at this. When it comes to the pessimism, here's what the Financial Times says right here. Skimming, scanning, and scrolling. The age of deep reading is over. Holy smokes, how common is this? Or at least, how often do we complain about this on the YouTube channel? I feel like we're always complaining about this here on the YouTube channel, or at least I am, which is that the level of depth that we are seeing in educated market commentary is so superficial. It's just superficial is the better word. Superficial is the geological term. So it's superficial reading. So people just skimming off the top. And that's what it seems like. Skimming, scanning, and scrolling. This is like the Twitter age and the TikTok age. And so what you have here is the Financial Times just released this. And they basically, it's a really good piece, but they basically talk about how today, people potentially are much unhappier and that there's a lot more negativity going on because people are much more used to scrolling, getting headlines, sharing negativity, and not actually going into depth of reading content. This article, there was another one in the Times about this. So it's the Financial Times and the New York Times, both covered topics on this. This particular one in the Financial Times goes as far as saying, when you end up having a society that does not care about deep perspective and only cares about sizzle, we're gonna, like, I guess an example would be like, vote for me for student council. Why? Free ice cream for everyone. That's popular. That's populist amongst everyone. Everybody's like, yeah, okay, I want free ice cream. But then you got real problems like, okay, well, how are you going to solve tutoring or mental health education or after school, this, that, whatever, right? Like all the programs. How do you, what's the actual nuance? Well, all that gets lost in the headline. It's who's got the better headline on the scroll apps. I think YouTube has a really neat advantage here because we escape that sort of headlineism. Don't get me wrong, like there has to be an attractive headline to click, but then you listen to perspective and depth. And so it's so fascinating to me that now you have the Financial Times, because we talk about it so much, you have the Financial Times talking about the same problem. It's not just them, but it's other outlets as well. Probably, potentially because their views are going down, as a result of some changes over at Twitter as well. Now they're no longer hyperlinking articles. They just show a picture. So it's kind of like they're ripping the thumbnail of articles, and then they don't even show that it's a clickable link, even though the picture is now clickable. Kind of wild. I mean, it cleans up the app, I guess, a little bit. It just makes it less interactive. It certainly feels less interactive. But anyway, very interesting. So what do we have today in terms of earnings? We have Pinterest. We have, so we'll definitely cover Pinterest. Maybe we'll cover Chegg as well. Those are Simon Property Group. I really want to see what's going on at the malls. That consumer spend. One of the things that we're finding, by the way, when it comes to the consumer spend is that consumers are spending less money on large purchases and more money on smaller purchases. So keep an eye on that. If you see a lot of smaller consumer spend, like, people are buying Barbies or, I don't know, Legos or Nike shoes or whatever, that doesn't necessarily mean you're going to get really good retail sales on things like cars and, oh my gosh, Enphase solar systems for your homes. It's like, truth be told, these larger durable purchases, solar, cars, the big investments, those are like sucking right now, because who wants to dedicate that kind of capital in this sort of environment, an economic environment, especially where rates are so high? You go buy, here, like, I don't have it handy here, but like an iPad mini, okay? What's an iPad mini going to cost you these days? Like $500 or something like that? You put that on BNPL. Do you really care that it's now 26% interest instead of 15? No, the difference of 10% interest is like $4 a month. Do you really care on a $500 purchase that the interest rate is 10% higher? Not really. Like I said, it's $4 a month. Now, do you care if the interest rate is 10% higher on a solar panel system? Hell yeah. Because all of a sudden it doesn't make sense anymore to buy solar. All of a sudden it doesn't make sense to buy an EV anymore. All of a sudden it just makes sense to go stick your head in the sand and forget the stock market and quit entirely, which I won't be surprised if after these years of hell, like 2022, 23, maybe the beginning of 24, all this insane volatility, I won't be surprised if there are a lot of people who say, you know what? I've had it. I'm just going to focus on my career, focus on getting skilled, licenses, education. I'm done with the stock market. You're going to see a lot of that. And I teach a lot of that in my courses on building your wealth, the New Verse Pro courses or the other ones that are already out, how to provide more value to your employer, how to start your own business, LLC, side hustle, all that. You got to be a well-rounded person, but that should also include real estate and stock investing. But I won't be surprised to see the stock market investing community shrink substantially. Not great for some of the stock-related companies. Now, one of the things that is interesting is what's been going on with SoFi today. So from a market commentary point of view, let's take a look at SoFi, because this morning, SoFi was like, I don't know, it felt like straight clickbait or something. SoFi was up, mega up, okay? SoFi was up somewhere around 13%. Look at this. You got rejected by the fib line. Oops, wrong button. You got rejected by that Fibonacci line hard. Look at this. You come into a rally in pre-market. Pre-market purchases, very common to be retail purchases, low float. They drive selling pressure at the open, but buying pressure for about the first 15 minutes. What do you get after that? Boom, plummet through the next Fibonacci retracement line. When we break that, we almost break down to the next fib retracement line. And now we're in no man's land, just being supported by the day's moving averages. If we actually go out to the real moving averages, we just broke the 200-day moving average. The other would obviously be the 200-minute moving average. But anyway, now we're back under $7 at SoFi. It was like a rugging. It's like, here's 13%. Yay, SoFi's killing it. Boot rip. What the hell is going on? I'll tell you, SoFi took a big goodwill write-off. We went through this in the course member live stream. When they don't have goodwill write-off, if they didn't have that goodwill write-off, they would have nearly been break even, which is actually pretty impressive. And they grew their user accounts year over year like 47%, but their advertising only grew like 15%. They are making money hand over fist right now, selling these high interest rate loans and making money on people's deposits. SoFi is actually doing pretty impressively. Now, that's not like, I'm not an investor in SoFi. I don't have a positive or negative position in SoFi. Just saying, a lot of people have been asking me about this one. They're not cash flow positive. They finance to keep growing, right? They borrow money to feed their losses. So you don't have the strongest, in my opinion, cash flow position yet. But then again, what good is cash flow doing you these days? Look at a company like Enphase, which has glorious cash flow, which is dead. I mean, this company just feels like it's going straight to bankruptcy. It's a phenomenal product. It's a great company with great wholesale integrations. Problem is, the wholesalers have all their warehouses stocked full in a high interest rate environment because everybody's like, yeah, I'm going to wait till next year. It's even what the real estate sellers are saying, and so you got to be careful. There could be a surge of inventory in the spring. But then again, everybody's been worried about a surge of inventory for a while. We just put one into escrow for HouseHack, one that we think is probably worth somewhere around like 775, maybe 8, given that there's a comp in the same neighborhood next to a busy road. The comp's next to a busy road for like 817, which is crazy. But we just put one into escrow for like 605. And we think it's worth, a good chunk more. Now we got to put a lot of work into it. But it's a great deal. We got to deal with the tenant, and like the sewer's got a problem. And I like looking for this stuff. Like the property's got some aluminum wiring. So there's definitely work to be done. I like to go to these properties and inspect them. I'm a big fan of that. So for example, I actually have a picture here of some arced aluminum wiring. Take a look at this. So if you don't know what to look for at a home, you get screwed, and you don't want to get screwed. So this is kind of where some of my many hours of real estate come in. But I love this kind of stuff. This is just an example of one right here. You got a little bit of arcing there on that wire. You can see the aluminum wire head right there. Some copper, some aluminum. You can see they've used the solution to connect aluminum to copper when you've got a mixed system. But anyway, it's really interesting. There are definitely opportunities. There are going to be a lot of opportunities, I think, this Q4 and Q1. We'll see. Anyway, we've got about 8 minutes to the bell, and then we're going to hit some earnings. Remember that HouseHack fundraise ends on the 1st, which is Wednesday. That's Fed Day. Email us at ir@househack.com if you got questions. Talking about the consumer, though, we do have Pinterest coming up. Not only do we have Pinterest for earnings, but we're going to be looking at Chag, Simon Property Group. These are 405. Public Storage reports at 405. Maybe we'll take a peek at them as well. Pinterest is supposed to be 405. All of these just 5 minutes after the bell. So within about the next 10 to 13 minutes, we'll be covering some of those earnings as they come across the wire. Otherwise, it looks like we've got some fear that now, Tesla's falling under this fear that, the UAW might be coming next for Tesla. This is because the UAW potentially feels empowered after having beaten up GM and having beaten up Ford. Is it possible for them to beat up Tesla next? So you have Tesla falling under the weight of these fears. Tesla's down nearly 5%. Just not only broke another fib, but not only did we break another fib, we broke the 200-day moving average. And last time we broke a moving average, it wasn't pretty, okay? The last time we broke the 100-day moving average, which look at that support. Broke support. Oh no, broke the next fib. Oh no, broke the 200-day moving average. Oh no. On the technicals, we're heading to 175 on Tesla. So buckle up, because if you break 175, you're going back to the end of 2022. Now, I don't think that's terribly likely, but then again, it's happened. Just look at Enphase, breaks through every level. Pretty wild. So anything can happen. But anyway, so watch that if you're trading on technicals here. Watching for the close here, we do have the QQQ back up 1%, shaving off a little bit of that rally into the close, but you did get that rally. Looks like the last 15 minutes here of trade burning up a little bit. But there is talk about this UAW potentially coming for Tesla out in California, Texas, Nevada, New York. How can they start getting some plants in the plants, so to speak, to convince Tesla workers to unionize? Probably the worst possible time for that to potentially happen, but stock market's certainly starting to price in some of those fears too. Yeah. Hope you got yourself a nice drink too. So what do we got here? Tesla, by the way. We looked at. Intel's the other one I wanted to look at. 5 minutes to the close here. Intel. I got a position in Intel. Obviously, I got a position in Tesla and Enphase as well. But I always want to be transparent here. Bullish position in Intel. No shorts on any of these. Personally, this is one that I like a lot. I think people really care about their personal chip making IP. I don't. I solely care about them as a chip manufacturer. That's it. That's the only way I value them. Anything else is bonus. I want chip manufacturing in America, and I think Intel is going to be the one to do it. So I've been pretty excited about Intel. We'll see how it goes. Another one that I've been looking at, but I haven't done anything with, is Intuit. I think that if we do go through this recessionary period, Intuit's probably going to get smoked. It's already started coming down since September, but I wouldn't be surprised if this could actually go substantially lower. I wonder how expensive it would be to short this sucker. But one of the reasons first of all, I like Intuit because massive cash flow, massive recurring revenue. Once people are into the Mint.com, the QuickBooks and all that stuff, you just get suckered in for a long time. So the problem with this, though, is in a high interest rate environment, the biggest stress is usually on your small business. Small business is more likely to use Intuit, which is also unfortunately true for Ubiquity, which I have a position in, which has absolutely gotten destroyed. But it makes sense when you consider the interest rates are really affecting some of these small business, medium business related companies, your Intuits, your Ubiquities. And I wonder if some of that pain is still to come through. So that's an interesting one that hasn't fully fallen yet, but I'm definitely keeping an eye on Intuit here. I can't get around getting into something like Chipotle even after their last earnings. I think there's a limit to how long these higher prices are going to last for food. I think McDonald's gave us a really good heads up that in Q3, they finally had inflation inflect down substantially, in more in line with what's happening in the rest of the economy. and that year over year for the first half of the year, they're up 10% in pricing, but that's comparing to Q1 and Q2 of 2022. Now they're normalizing. So I think the days of these companies bragging that they have, faux PP in inflationary pricing power, which is bullshit. It doesn't last. Are very, very limited. Very interested, though, also to see what happens at the Mac event today. Of course, expected to hear about the M3 processors from Apple. That event starts, is it 5 p.m. Eastern? I think it's 5 p.m. Eastern. It's the, it's the 5 p.m. No, it's 5 p.m. Pacific time. Oh, wow. Okay. So they're doing 5 p.m. California time. That'll be right towards the end of when we're doing our podcast. So maybe we'll finish that early and jump into the Apple event. That could be kind of cool. But anyway, Apple event at 5 o'clock. So then look at that. Lovesac up 10% today, coming off a bottom. Lovesac has been crashing since about August. I mean, it's down almost 50% right here, but just had a little bit of a pop. 2 minutes now from the close. But let's look here. We've got, I want to see what's going on with LOVE, not to be confused with, is it Spirit Save? Southwest is Love. Yeah, the airlines. Oof, airlines, man. Okay, Lovesac, net sales miss estimates, barely. Okay, so they're up on a miss. Yeah, makes sense. The stock market makes sense, everyone. Lovesac being investigated by Block and Leviton for potential securities violations, misses estimates, up 10%. Totally normal, folks. That is the stock market we are in. The most innovative companies, beep. Oh, it's comedy. You can't be in the stock market if you don't have a sense of humor. If you wake up and the first thing you do is you look at a specific ticker symbol, you have too much in that position, okay? You have way too much stock in that position, and you got to diversify. Not personalized advice. Let's listen to the bell together and get into some of the earnings.
Stability. They haven't come down that much, but they haven't gone up a lot anymore either.
That's right. So therefore, it's about waiting for Wednesday with the Fed and the Treasury announcement.
Which is why our viewers are so smart and said Wednesday matters more than anything for the Fed meeting to the near-term direction of the stock. I'll see all of you tomorrow. I'll send it into OT now with Morgan and John.
I love the bell now. Now I always listen now to see if people are screwing up the bell, because now I know how the bell works, having held the button for the bell. And sometimes you hear him skip a beat. It's like, you lifted your finger too early. I don't know. It's pretty niche, but I think it's pretty funny personally. All right. So by the way, expect after this, we're going to be posting a little video of our twins. So stay tuned for that. I'm pretty excited about that video. That'll be after this live stream, maybe about an hour after. Right now, we do have earnings on deck, though. Simon Property Group, Public Storage, and Pinterest. Oh, boy, pandemic play. So we are waiting now. Pins, Simon Property Group, Public Storage. Want to see if there's any other one that we really want to hit here. No, that's probably going to be it for the primary ones we want to cover. Maybe Chegg as we wait for the numbers. What we'll also do is while we wait for these earnings to come through, let's go look at the break evens here. I got Chegg up. All right, let's go look at the break evens. Opsar says, can't even tell people to diversify without giving that disclaimer. Man, you gotta have a disclaimer for everything, man. If I tell you to go to the bathroom, I gotta give you a disclaimer. Like, go to the bathroom. Don't hold in your poo. Not medical advice. Yeah, get your licenses and you can enjoy the pleasures. So I have to say, break evens, the market's not having the idea that inflation's going to go away. Now, like, I'd like to be the one to tell you it's going to go away because I read all the earnings calls and I'm like, oh, it's going away. But obviously, we just have a lot of lingering inflation. It's going to take a pretty minute before it actually before everybody's actually convinced of that, right? That's the problem. It's just early on inflation going away. It just feels like crap. But these are the break evens right now. So the 5-year forward break even on screen now. That's not a great trend, okay? This is what JPOW has to get down. I mean, since April, it's been straight up. Not great. 2.48, not great. And then you look at, obviously, wars accelerated this. This is the 5-year break even. The difference is the 5-year break even is from now, 5 years forward. And then the 5-year forward is in 5 years, 5 years forward. Crazy, huh? So, whoo, boy. Anyway, that's what you've got in terms of inflation expectations. Clearly, the bond market is not convinced the Fed has done enough. And this is now pricing in the higher for longer, not a higher terminal rate. Terminal Fed funds rate after today's volatility still basically sitting at the same spot, which is also really interesting. With this morning, we were looking at it, we're at 5.38, a little bit more than 5.38, just above it. Right now, as we're waiting for Pinterest, Public Storage, Simon Property Group, Chegg, as we're waiting for those. We're essentially at the same spot for the Federal Reserve's terminal rate. Terminal rate right now sitting at, 5.3872. So it basically didn't move at all today. Pretty convinced the market is that, boy, I sounded like Baby Yoda, or not Baby Yoda, Adult Yoda there. You just say everything in a weird order. Pretty convinced the market is that the Fed is at peak. Anyway, I've been watching too much Star Wars with the boys. Anyway, that just means higher for longer. Nobody really wants to hear that. Certainly not Enphase or Tesla. Ugh! Who would ever recommend those dog stocks? Don't worry. There's always a drink for that. All right, Pinterest Public Storage. Simon should be out within the next 60 seconds. On deck now.
Because Fed Chair Powell sort of alluded to the case that, the fact that Treasury yields rose across the curve means they might be done tightening. I think he might reiterate that. I mean, how much the Treasury yield curve has steepened out and how much the back end of the curve has risen, that is a lot of tightening that the economy has to digest. So I think that doesn't count for only one, but possibly 3 rate hikes. So I think if the Fed delivers that sort of message, that could be a near-term bullish catalyst for the markets.
And
Samir, that's it.
You still see downside risk in stocks? Think we're going to test?
Okay, here we go. Public Storage comes in with a beat. Revenue matches at 1.14, but let's see here. This is per share. We've got 433 versus estimates of 419. Slight beat there on Public Storage. Simon Property Group comes in with a beat. $3.20 versus $2.97 at the malls. Remember, the malls make a percentage of their money from gross revenues at the stores. So this is actually a good tell of the consumer buying smaller, junky things. It does you nothing for Enphase or Tesla, okay? Those are big, durable purchases. All right. Waiting for Pinterest to come through as well. But here's Simon Property Group, up about 67 bips. Boy, I remember when this sucker was like $50 during the pandemic. That was back when, all of them were going to shut down, basically. All the malls were going to go bankrupt. Anyway, here's Public Storage, barely moving at all as well. You've got Public Storage so far this year. Oh, that is pretty much down. Yikes. All of a sudden, you kind of just dropped off a cliff there around the 19th of October. So just within the last couple of weeks here, leading into these earnings. So Public Storage, PSA stock. So far, year to date on this one, you're down 12.9%. It's actually not horrible compared to some other things. 1 year, you're down 22%, though. Yikes. You were back at 2021 and 2019 levels. Rip. Okay, so, cute little baby picture. Here's a little updated baby picture. Spoiler alert, updated baby picture. Hello, Ella. Aww. Hi. It's so cute. Still not home yet, though. Waiting for Claire now. You'll get an update on that in the baby video coming out shortly. Pinterest comes in with average revenue per user is $1.61. The estimate was $1.61. Pinterest up 6% in after hours already. Adjusted EPS coming out at 28 cents. It's a beat. 28 cents versus the estimate of 20 cents. Monthly active users coming in at 482 versus 473. EBITDA 184 versus the estimate of 131. Worth looking at how Etsy reacts after this. Let's take a peek here. Etsy. No movement on Etsy, though what you can see with Etsy as well is that you're breaking through one of those lower fib levels. Yikes. Look at that burn. Let's go to the week chart on Etsy. Oh my gosh. It just screams COVID. Yeah, yikes. That's crazy. So that's Etsy for you. Boy, oh boy. Okay. So Etsy comparing now to Pins. Pins in the after hours fading already, up 5%. Looking at PayPal, which has earnings coming up this week, also breaking those lower fib levels. Yikes. And Simon Property Group, again, beat on PSA, beat on Simon Property Group. Chegg not out yet. Pinterest, we've gone. Reports Q3 monthly active users up 8% from last year. Very interesting. I want to see a little bit more if we can get some Pins investor relations here. Let's listen in here for a moment.
Now, as for fourth quarter guidance, the company gave a range. Now, the midpoint of 12% revenue growth of that range, that is ahead of the 11% growth that the street was estimating. So there's been no commentary in the release on whether the company is seeing any uncertainty or potential pullback in ad spending in the fourth quarter, which is a warning we got from Snap and also from Meta. But we will be listening for more in the earnings call, which starts in about 20 minutes. CEO Bill Reddy saying in Pinterest's release, quote, as we lean into Pinterest's unique differentiators as a visual search, discovery, and shopping platform, we're finding our best product market fit in years. I will have an exclusive interview with Pinterest CEO Bill Reddy that's coming up tomorrow in the 11 a.m. hour of Squawk on the Street. John?
All right, Julia, thank you. Meantime, VF Corp moving about 6% in the other direction down. Steve Kovac has the numbers there. Steve.
Yeah, John, shares tumbling a bit here on some mixed results from VF Corp. EPS coming in at 63 cents adjusted. That's a miss on estimates of 65 cents adjusted. And then revenue is pretty much in line here, coming in at $3.03 billion. Street was looking for about $3 billion even. And you see shares down, John, about 5% now. Send it back over to you.
All right, thank you. Looks like a dividend cut here as well. Let's go.
This is really interesting. I'm just looking at Simon Property Group here. We've got occupancy at 95.2% versus 94.5% of last year, an increase of 70 basis points. And then you have rent actually up 2.9% at that's the minimum level, not the average level. Average level could actually be down. So interesting on Simon Property Group. Let's keep listening here for a moment.
Christina Partsinevelos has the numbers on that chip maker. Christina.
Yeah, we're seeing revenues that are falling short of expectations at $197.4 million. Street was anticipating over $207 million. Adjusted loss per share came in at 53 cents. So that is a little bit better. For Q2 revenue guidance, we're getting a range about 192 to 222 million. So that is a little bit less. If we go through the report, though, there was a section on the startup costs, Wolfspeed saying that they're incurring significant factory startup costs on construction of their facilities, Siler Lake in North Carolina as an example, and those facilities are not yet earning revenue. Those startup costs and underutilization costs come out to about 34.4 million. And yet the stock is popping 10%. Still unsure why that's happening, so I'll have to come back to you and figure out what it is that's driving that name higher, given the miss in revenues.
This used to be a company called Cree, by the way, Wolfspeed. They do like chips that work on radio frequencies and like communicate, like think Internet of Things kind of technology, LED light bulbs, smart switches and such. There's a lot more to them, and I'm probably not explaining it the best I could, but I'm not extremely familiar with them. I just know they changed their name from Cree, C-R-E-E. And it looks like their loss per share was less than expected. Maybe that's what she was missing in terms of why they're popping 53 cents versus the estimate of 67. So basically losing less money than expected. Yay. Those are the stocks that go up. Yay. Losing less. What do we got here? UAW, we got the agreement with GM, but here's some of the info. Starting wage will increase to over $30 an hour. GM to make $2,500 lump sum payments to retirees, a new agreement. GM workers will end strikes. pending contract ratification. Wow. Cumulatively raised the top wage by 33%, compounded with estimated cost of living adjustments to over $42 an hour for GM workers. That's some GM tape for you. Wow. Very well. Well, this gives us a little bit of a breakdown of some of the madness that's going on and has been going on in the market here. At the same time, we got the U.S. Treasury reducing how much borrowing they think they have to do, which that's really interesting because maybe that means issuing less T-bills and bonds, which means less supply means higher price would mean lower yield, maybe, thanks to stronger than expected revenues. Wow. There goes the offset to the fear that the Treasury was going to go nuts on borrowing here. Don't get me wrong, they're still going nuts, but they borrowed about $70 million less than they did in the last quarter. And the estimate was about $750 billion. They came in about $776 billion. Oh, well, I guess that'd be about $70 billion of a difference, not $70 million of a difference. Yes. Yeah. So, you know, it's a problem when you're confusing your M's and your B's. Anywho, stay tuned. Tomorrow, we are actually going to do something pretty cool. I'll link you all to it so you can get a reminder for it. But tomorrow, we will be doing a Jordan Belfort interview, expected to be tomorrow morning. Stay tuned for that. That'll be really cool. It'll automatically redirect you to that, so you can hit the little remind button on that in just a moment. But I just have to get through this really quick. Even though I'm a licensed financial advisor, licensed real estate broker, becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. By the way, check out HouseHack. Fundraise closes in 2 days. HouseHack.com. Email us at ir@househack.com if you got questions. Actively doing multiple deals and renovations. Really excited, but also keeping a lot of dry powder for those deals that are coming. And boy, they're getting more and more juicy by the day. We're excited by that. Keep in mind, this is not tax, legal, or otherwise personal advice tailored to you. It's generalized perspective. I think I pretty much told you what positions we've got. And yeah, no shorts. Thanks so much for watching. We'll see you in the next one. Get that redirect link and hit remind for the Jordan Belfort interview. See ya. Bye.